So this next module material extends a bit into the income statement. We've already developed a proper income statement. There's just a few more things that we have to consider. One is earnings per share. And so this one is a required disclosure on every income statement that is submitted for an annual report. And it appears at the bottom of the income statement. And what we're trying to get with the earnings per share disclosure is an assessment. It's not a perfect absolute truth, but it's an idea of how much of the current period's earnings or net income is able to be paid to each common shareholder. So we have net income, and that represents the wealth that the company generated during this period. We subtract off preferred dividends, any dividends that will be paid to preferred shareholders, because those dividends must be paid before common shareholders can access any of the wealth generated by the company. So we take the total wealth generated during a period, our net income from the income statement, subtract off preferred dividends, and then we divide it by weighted average common shares outstanding. So we get the amount of wealth that one share of the company's ownership entitles its owner to. The weighted average instead of a simple average. So weighted average just means that we're going to take into consideration how long the shares have been held for. For example, if we hold, if there's 10 shares outstanding for 11 months of the year, and then in the 12th month, the company issues 100 new shares. So now there's 110 shares at the end of the year. Well, we don't want to just take the average of 10 and 110 because that would grossly misrepresent the weighted average that's been outstanding for the period. So we'd weight the 10 by 11 months and then weight the 110 by 1 month. I'm not going to have you solve for weighted average. I just want to let you know what it is. And I will give you what the weighted average common shares outstanding were for the period. So we have to disclose on the income statement, and we could have up to 3 EPS we need to calculate. We'll have 3 EPS when there is discontinued ops. So if the company has disc ops going on and that's not resolved, then we have to have 3. If no discontinued ops, then there's only 1. So if there's no discontinued operations, then the only EPS we need to worry about is net income less preferred dividends divided by weighted average common shares outstanding. If there are discontinued operations, then we have to calculate 2 additional ones. One of them will be, instead of assessing net income less preferred dividends, we look at income from continuing operations, deduct preferred dividends divided by weighted common shares outstanding. Then we also want the one that we will always calculate, the net income. And that's going to include the discontinued operations and also include the effect of preferred dividends. So it's just verbatim, this one up here. The third one, this one in between, is the effect of discontinued operations. And because that's an adjustment from one subtotal to another, from income before discontinued ops to net income, that one does not consider preferred dividends in its calculation. So let's look at how this disclosure, I just say we exert this from an income statement. This disclosure here would give me everything I need to calculate the EPS, given that I also tell you the company declared $5 of dividends, and these are we will assume, because otherwise it wouldn't matter, $5 of preferred dividends, and had 100 shares weighted average common shares outstanding during the year. need to make a past of that past parcel. So we need 3 EPS disclosures because we have discontinued operations. So our first EPS will be the income from continuing ops. And we have this one, of course, because if there's discontinued operations, really, which is more relevant to an investor, the total income or just the income from continuing operations? Really, if I'm an investor in a company, then I'm more interested in the income from continuing operations because whatever's being discontinued and whatever effect that has on my total income for this company, for the company that I own, the discontinued operations are not going to be present for a lengthy period of time. So this is actually a more reliable indicator of what this company will provide to me in the future. So we have income for continuing operations EPS, and we take take this formula, but instead of using net income, we're talking about the income from continuing operations. So we're going to take that $100 up there. And we do need to subtract off the preferred dividends. We subtract off those preferred dividends, and then we divide it by the 100 weighted average shares that are outstanding for the period. And so solving for that gives me 95 cents per share. Now, we look at the effect of the discontinued operations, right? And as I say up here, it's an effect, it's an adjustment, not a subtotal. So we do not consider this a pool of wealth that is due to common holders, whether it's positive or negative, right? This is just an adjustment from one pool of wealth, $100, to another pool of wealth, and it's either going to positively influence that or negatively influence that. But it's not something that we have to deduct. Oh, this, I would have gotten all this money, but now preferred holders need to be paid their dues. Because it's just an adjustment and not a subtotal, we have a discontinued ops EPS effect. It's not really even a true EPS. It's just an EPS effect because it's, again, not wealth that's due to our shareholders. And it's $12, negative $12. So we do want to maintain the negativity of that because it will reduce the EPS that is calculated with net income. We divide this again by 100, and that comes out to a negative 12 cents per share. So that's the effect of my discontinued ops. Now, EPS, because we are adjusting things appropriately, will always add up to the final one. So for example, 95 cents per share, and then this adjustment for 12 cents, negative 12 cents per share should come out to 83 cents per share just by taking that, subtracting that, and then I get the final EPS. And we can check it real quick just to make sure that this worked right. Now this is the basically, I would say, the true EPS, but we can call it net income EPS just to kind of ground it in what it's based on. And that is going to be the $88 of net income less the $5 of preferred dividends divided by $100. And that does come out to 83 cents a share after you do the math. Right. So that's basic EPS, not a big deal. It is huge in the business media. Whenever you hear about earnings announcements, companies are throwing or announcing their quarterly and yearly EPS numbers. There's a lot of trades and activity going on in the stock market at that time. So it's a very important number to be aware of and to know where it comes from. It's actually a pretty basic measure to calculate. Now, if there are convertible securities, and what I mean by convertible securities is maybe we have employee stock options where employees could buy shares of the company stock at any given time. Maybe we're talking about bonds that can be converted into common stock. Maybe we're talking about warrants or call options and things like that. So when those more complex securities are in the mix, we also have a measure that we calculate called diluted EPS. And what the dilution represents is that if those holders of those complex securities or those call options or those stock options are going to exercise their right to buy shares or to convert into common shares, then this denominator could blow up. It could get much higher if they decide to do that. So what the diluted EPS is doing is just saying, okay, let's consider the worst case scenario. If all these people decide to exercise their options, then this is the effect it would have on my overall EPS. It would not be the basic EPS, it would become the diluted EPS. So that's the first piece, earnings per share, not too difficult. Comprehensive income, this one starts to get people a little bit more turned around. It's a new item, a new topic that is not talked about in intro. Net income. All this time we're talking about net income. It is definitely the income figure that the business world is most focused on. Investors and creditors, they want to know net income. We've calculated everything that goes into income, but there are some items that do not immediately hit net income. So this introduces the idea of comprehensive income. Now, comprehensive income is below net income. There are actually three ways of disclosing, or three options for disclosure. It can be disclosed on the income statement itself. So we have basically a continuous income statement from sales revenue all the way to net income, and then from net income to comp income. So it's an expansive statement that includes everything we saw before, right? Which is all that sales revenue to net income, and then extra components, which we're incorporating now, the comprehensive income. You can also disclose it in the statement of shareholders' equity, which includes other equity related items. Basically, it's just an accounting of everything that happened to the common stock, the retained earnings, and accumulated other comprehensive income. The most common way, so I'll put like a couple of little stars by it. This is the most definitely the most common method of disclosure, is a separate statement of comprehensive income. And when we have a separate statement of comprehensive income, what we see then is just net income at the top of that statement. And then they take it forward to comprehensive income, which I shorthanded comp income, but it's the same thing. Comp income, comprehensive income. It would be there. So those are the three methods of disclosing it. Now, comprehensive income, it sounds like it's this extremely important measure because it's comprehensive, right? Certainly, this is giving me a more complete or comprehensive view of the company, but that's really not the case, honestly. That is not how this works. Net income is actually a more informative measure. Now, comprehensive income is not without its benefits in terms of being able to predict some income movements in the future, but largely it is more a place for us to put items, gains and losses that are not currently being recognized in net income, but will likely be recognized in net income in the future. So in that way, it's kind of a holding ground for those gains and losses that we're just putting them down here for now because sooner or later they're going to have to get rolled into net income. Now, some of this is that US GAAP requires us to change the value of certain assets and liabilities on the balance sheet. And that change in value is ascribed to a gain or a loss. Those gains and losses will become other comprehensive income. So these gains and losses tend to be extremely transitory. That's one big reason they are not put into net income. Because remember, we want net income to be a great measure to predict future net income. If we have things that are transitory, that are gains this period, but will be losses the next period, that will be up then down, right? This makes it much harder for us to predict future income. And this is smoothing our net income, making it more predictable and increasing earnings quality. So what goes into other comprehensive income? First thing I want to kind of map out here is just a couple of terms. And we're going to add one more, but we have basically our net income. So think of everything that's been developed up to this point. You'll see it again on the next page, but I think it's good for you to write it. We have our net income, which we derived up to this point, right? This contains everything we saw from Module 5, sales revenue, COGS, operating expenses, non-operating items, tax expense, discontinued ops. Now we're taking net income, and then we will add some other comprehensive, and I'm going to shorthand it again just with comp, income, gains, and then we'll subtract any other comp income losses. And after we do that, we have comprehensive income. So we now comprehensive income. We now have two of the abbreviations you will commonly see. We have other comprehensive income and we have comprehensive income. So we're going to add one more that adds one more letter when we talk about the balance sheet. But for now, these are my OCI items, other comprehensive income, right? These are flows, additions, subtractions, adjustments, however you want to call them. This is my OCI. Comprehensive income is my CI, right? This is a subtotal. This is not an adjustment. This is all my OCI items plus added or combined with net income to get comprehensive income. So what goes in there, right? We have a few things. 4, in fact. These are the biggest 4. There are a couple of other random rare items, but these are the 4 most common ones. You should know them just by sight so that you know to not include them in an income or net income. You just want to have them below net income, not affect it. We have unrealized gains and losses on available for sale securities. So this is available for sale securities are a type of investment that needs to be reported at fair value. And so at the end of the period, if we haven't sold those available for sale securities, if we're still holding them, they will have a different value than they had at the beginning of the year or the beginning of the quarter. So because their value is changing, we need to recognize a gain, an unrealized gain on that, maybe an unrealized loss, right? But we will not be including this gain or loss into our net income until we actually sell the security. And that's a lot of the rationale behind a few of these items. Unrealized translation gains or losses on foreign currency. So this is basically when a company is international, they have foreign assets, and those foreign assets, the value of those assets is in the denomination of a foreign currency. And so by that measure, when the company is translating that foreign currency to US dollars, the exchange rate is going to come into play. And those assets that they hold are going to be at different values depending on what the dollar is doing against whichever foreign currency the asset is in. And so this is going to be the purview of an international company with um, businesses in different countries. And again, since those assets are changing value, this is just a gain or a loss based on where that dollar to foreign currency ratio was at the beginning of the year versus what we can get for it now. And again, it'll go all over the place because currencies gain and lose strength against each other all the time. Unrecognized gain or loss from employee pension programs. So sometimes in our pension programs, this is when we change our pension programs, um, change the payout of pension programs predominantly. When our employees retire, they either get more check or less check. Um, in this case, this one isn't so much that it's going to keep changing value as when the benefits of our retired employees change, it is a huge loss typically because they're increasing benefits. Sometimes, very rarely, they'll decrease benefits. But when they increase benefits, it's a huge loss that would have to be recognized all at once. We don't want to put that entire loss in net income right away. So we bleed it into net income over time, but we put the entire loss in OCI and then slowly recognize parts of it in net income over the years. And then the final one is a cash flow hedging transaction. We won't go too deep into derivative accounting, but basically it's the same idea as the investments reported at fair value. The cash flow hedge value will change. It'll increase one year, decrease the next. And that creates unrecognized, unrealized gains and losses on cash flow hedges. So all of these things are, again, transitory, not indicative of future trends in income. Also, most of these tend to be outside the control of management, right? Um, these gains and losses tend to arise from changes in interest rates, the ones on available for sale security. Unrealized translation gains and losses also could have it could be economic effects, it could be macroeconomic effects of the countries, it could be interest rates as well. Unrecognized gains or losses from employee pensions. Okay, that one really is in the purview of management because they get to decide whether they're going to cut or expand benefits. That's the only one really. And then these unrealized gains or losses on cash flow hedging transactions. I mean, it could speak to how well the company's structuring its hedges, but also is very much to the whim of the markets in terms of how these things change over time. Also interest rates. So things outside of management's control. The balance sheet presentation. How do we put all this onto the balance sheet? This is where the third acronym comes in because we have something called accumulated other comprehensive income. We saw it briefly in the balance sheet chapter, but I didn't really delve into it at that time. But yes, AOCI is an equity account. So it is very much like retained earnings, very similar to retained earnings. It can have a debit or credit balance. Remember that when it has a debit balance, That means that this company right now has a lot of OCI losses. Okay. More losses than gains. So that's on the debit side. And if you recall, most equity accounts, equity accounts that are normal have credit balances like common stock. Um, Credits increase equity. So when it has a debit balance, it is reducing equity. So it reduces my E in A equals L plus E. And when it has a credit balance, well, that means that we have more gains, unrealized OCI gains. It increases equity. And as I said, it's very, 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 very comparable to retained earnings. One way to think about it is if we take what I wrote up here, this net income plus or minus OCI gives me CI. Net income gets closed out to retained earnings. So it get all the revenues and expenses and the gains and losses that went into net income. Those we close to an income summary. Then we close that to retained earnings. OCI items go directly to AOCI, closed the same way. So, for example, we might debit an unrealized gain on AFS. And when we debit that, we will credit accumulated other comprehensive income for that amount. Okay. When we have to close a loss, we would credit the unrealized loss because these are still, I mean, we call them unrealized, they're OCI, but they still follow the rules of gains and losses that, a loss account is a debit, a normal debit balance, a gain account is a normal credit balance. And so when we close them, we're doing the opposite. So these would be the mechanical closing entries to take my OCI items and put them into AOCI. It's typically listed at the bottom of shareholders' equity section. And like I mentioned, it's comparable to retained earnings. It can have a debit or credit balance, as can retained earnings. It just means if we have that debit balance, it means we have more unrealized losses than we have unrealized gains. And like retained earnings, it collects the effect of income related items. I mean, it's in the name, accumulated other comprehensive income. Over time, it's accumulating the losses that have accrued in OCI. So if we had a $10 loss last year and then a $15 loss this year, then we would have a 25 in total, 10 plus 15, a $25 debit balance in my AOCI account. So this is just a continuation of the first income statement I showed you, where I had a template laid out. I started from income from continuing operations because this tends to be where people start having issues. And also it draws our attention to the fact that tax expense is taken out right before income from continuing operations. Now, this next section is our discontinued operations. We talked about that. We have to net tax from these items here. We net that tax effect over here. That gives me the effect of our discontinued operations and net income. Now, if this would be an example of a single disclosure. I just chopped it about in half, got rid of operating expenses, non-operating items, and sales revenue. But this would be that continuous disclosure of comprehensive income where we started at sales revenue. That's not here, but obviously it should be. And then we go all the way down to comprehensive income. Okay. Also notice we need to net tax effects from these items. We need to net those tax effects because there is a tax effect. It is not calculated in this amount here that's labeled income tax expense. This income tax expense is only the expense of all the items before it. Okay. So let's look at this problem. Big data has the following items that classifies comprehensive income effects for the year 20x6. And all these effects are pre-tax. So we have $127,000 unrealized loss for available for sale stuff, 154,000 unrecognized loss on cash flow hedges, and a 75,000 foreign currency translation gain. So we got all these OCI items. These are my OCI items, because these are what I need to include in order to convert net income into comprehensive income. If big data had net income of 1.73 million, a beginning debit balance of $130,000 in its accumulated other comprehensive income account, then we need to find the amount of comprehensive income and the ending balance of accumulated other comprehensive income. All right, so remember that when we're dealing with, we got net income. It told us about 1.73 net income. So it gave us this number right here. And in order to take it to what the problem is asking for, comprehensive income, then we should just lay it out like this. We have 1.73 million net income. We're going to assess the effects of all this OCI stuff that happened. And then we'll combine those together, add it or subtract it from net income to get our comprehensive income. So my net income is 1.73 million. Now my comp income, these are all pre-tax effects. And we need to net taxes out in order to get these numbers here. So we are going to net tax, we'll do a 20% tax on all these items. And that means that that $127,000 item now becomes 101.6. And remember that I am multiplying by 0.8 because what I'm acknowledging is if I take 20% tax off of this, that 20% tax is, if I calculate it, oops, 25,400. Well, if I take that tax off, then only 80% of this amount is remaining. And that 80% is 127 minus 25.4, or just 127 times 80%. And that is my 101,600. Take the 154, do the same thing to it, multiply it by 0.8. And that's $123,200. The first one was a loss. This is also a loss. And then the 75,000 foreign currency translation gain should be 60. So this one is a gain. We won't put the parentheses around it to show that it should have a positive effect on net income. All right, so we have our three items, pulled the pre-tax amounts, applied the after-tax tax rate to each of them, and that's our OCI items. So we would have this unrealized loss on AFS for 106 or 101.6. And then we have another unrecognized or unrealized loss on cash flow on, we'll just call it on hedges, being real shorthanded here. 123,200. And then we would have our unrecognized gain on on the translation of foreign currencies. 60,000. And then I just add all these up. And if you combine all of this, you should get net income. I'm sorry, not net income, comprehensive income of $1,565,200. Do the math on that one more time just to be sure I'm not giving you an error. So this would be our comprehensive income. This is one of the items it's asking for. The other item it was asking for is, well, what is the balance of my accumulated other comprehensive income account? And for this, we'll just make we'll make a T account and we'll look at AOCI. AOCI, it says started at a beginning debit balance of 130,000. Now, what do I need to combine in this? Be very careful with what you throw into AOCI. You only want to include these OCI in AOCI. If we were to try to stuff comprehensive income into AOCI, if we were trying to take all of this, it's problematic because some of this is from net income, right? Net income went to retained earnings. If we close net income into retained earnings and we close that net income again, because it fed into this number, into AOCI, we're double counting net income in our equity. So we only want to take these guys. We definitely want to take them after tax as well. The only thing that's left to do is to understand where losses and gains go. My losses need to go on the left-hand side. Think of them as, their losses, their debit accounts. They'll debit AOCI, 123,200. And 60,000 gain. So again, we just reconcile this account. It's 130 plus 101.6 plus 123.2 and subtract the 60. We come to 294,800. So it would have a $294,800 debit balance in my AOCI. This amount, remember, would be equity reducing because it is a debit amount against the normal credit balances of my equity items.